We'll get started here. Welcome, everybody. Appreciate you joining us today. This evening, Shaun and I are going to talk about everything equity compensation. I know we had some RSVPs from clients that we've met specifically on their equity compensation and talked about the strategy with them and the tax consequences. And some of you may be on here just to learn, right? To learn about equity compensation from an educational standpoint. So as always, I invite you, if you have questions, to put it in the chat box, and Shaun and I will make sure to answer that at the end of the webinar. So with that, Shaun, let's kind of talk about what we'll be talking about today. So we understand that equity compensation can become, a significant part of your overall net worth. So Shaun's going to talk about first kind of equity compensation basics. Why do companies offer this? How does this work in your overall compensation package? He'll talk about some things maybe you're not aware of if you're tied to a public versus private company and some of the liquidity events and tax strategy around each of those. And then we'll really dive deep into the different types of equity compensation. And I apologize right now, you'll probably hear a ton of, acronyms from us, but most of them will fall into these categories. So I'll hit on RSUs, restricted stock units, and Shaun will kind of go through an overview in the next couple slides. But RSUs is probably what we commonly most see when we deal with equity compensation with clients. Shaun will then take it into stock options. And this is where it gets a little bit complicated. So Shaun will do a really great job clarifying a few things. This includes, NQSOs, non-qualified stock options, ISOs, incentive stock options. And then we'll round it out with ESPPs, so employee stock purchase plans. So hopefully that's not a ton of acronyms for you, and hopefully we make it pretty clear, because really the point of this webinar for you is to help you make good decisions, right? Informed decisions, because each one of these, equity compensation types have different nuances and different tax consequences and liquidity events. So we want to make sure that you fully understand those before you make a decision. We'll talk about, the tax and planning considerations as we go through these, and hopefully bring up some, specific examples, and then, any common mistakes that we can avoid while we work through these. So with that, I will have Shaun take it from here.
Yeah, so I think one of the key things to understand is, not everyone is given stock options. Why do companies do it? And that's really because they are trying to get you to stay with the firm. They want you to be vested, meaning they want you to have interest in the company doing well. And they normally will come with a time period. And so when they give them to you, you may have another job opportunity, but now you've got some stock options that if you stay a little bit longer, then you can get some equity, right? Or some, ownership of the firm through these different stock options. So it's really a way for employers to incentivize you to stay with the firm, do good work for the firm so that profits are better, the company's value goes up. So it's trying to align the company's incentives with the employee's incentive. And so it can be a really useful retention tool, and also good sign-on bonuses. We see a lot of clients get stock options when they first sign on, again, making sure that they stay with the firm and they want the firm to do well. And so that's how it kind of fits in your total compensation. They may give you a lower salary and more stock options. Oftentimes people that get stock options feel like they're the cool kids in school because not everyone has them. And so you get that kind of offer and you're like, hey, this is pretty neat. This is not something I've had before. And there's a lot of opportunity if the company does well that it can actually be worth more than what I'm getting in my annual salary. So a really neat, interesting, useful tool to compensate people in a unique way. But as we'll show today, it's not always valuable. And so we will kind of undress some of the, hidden things to look out for when it comes to stock options. Another thing to consider is whether or not you're a private versus public company. And so those have different liquidity events, and we'll kind of talk about it. But it's a lot easier for a startup company to say, hey, we'll give you these. Here's the plan that kind of covers it. But those rules can change as well versus a public company that's traded on the open market. And so we'll talk about some of those common forms that we see with clients, questions that we get with clients. We want to make sure we're being proactive in getting you the information before you kind of reach out to us. So we'll kind of jump into what's the difference between a private and a public company. So from a private company, think about like a mom and pop shop, right? Or a family owned business. Something that I can't log on to Charles Schwab or E-Trade and go buy shares of that company. So that company is not easily sold. There's not a lot of liquidity to it. And so if I want to get rid of my stock options, I may not have the opportunity to because there's oftentimes needing a liquidity event that would be published in the plan document that says, hey, you can get rid of these shares when this date occurs. Whereas if I own a publicly traded company and my shares are vested, I can sell them at any point in time on the open market because those shares may be traded hundreds or thousands of times a day. And so there's more liquidity when it comes to a public company because it's sold throughout the day on the open exchanges, less liquidity with a private company. How the company is valued. So oftentimes it's kind of misunderstood about public companies is I am looking at the price of, let's call it Apple. That is what the market, right? Millions of people that are buying and selling Apple within a day, that's what they believe the company is worth. And to get nerdy on you, it's the discounted present value of all its future cash flows, meaning we assume Apple's going to grow at 10%. Therefore, it is now priced at $500 a share. If they grow at more than that, then the share price goes up. If they start to decline in revenue, the share price goes down. And millions of people are making those transactions betting on what the price is. And so we can have a pretty clear understanding of how that company is valued. Additionally, they have to come out with public record. So they are going out and they have to make their financial documents open and available to the public, file them with the SEC. They cannot do things like insider trading. Whereas the valuation of a private company, it all varies based on how big that company is, how often they're getting valued. But oftentimes they will go out and pay an independent third party to come in, look at their books, and say, based on how you're growing, how much revenue you have, how much debt you have, this is what your company is worth today. And we divide that by the number of shares that are outstanding, and this is what the share is worth. So rather than being priced infinitely throughout the day like a company like Apple, it's going to be priced at certain time frames. It doesn't always have to be annual. It can be semi-annual, quarterly, but that's a cost to the company. So they'll kind of do it a lot less. So same exact thing. It's a retention tool, but oftentimes comes with a longer structure, right? So we'll see when we get to public companies, those vesting periods will typically happen at different times. Oftentimes you're set a quarterly interview or a quarterly kind of time period. Oftentimes it's an annual time period, but it can be more. With a private company, they don't want to go through. If I'm a startup company, I don't want to be giving out my cash a lot. So I'm going to make that vesting period longer and also kind of make it a larger incentive for that employee to stay with me. So we don't typically see as high of equity compensation with kind of private companies. So I don't have as much risk when I'm owning some of that company, unless maybe I'm a partner in that firm or something like that. When it comes to a public company, it's easier to diversify away that risk, again, because I can sell at any point in time. So a private company, going to be harder for me to get rid of those shares. I'm typically not going to have as many of them. With a public company, I typically get a lot of shares, right? Especially when I'm an executive, and then I can go sell them at any point in time so I can diversify away that risk. If I have a longer holding period as a private company, it's going to be harder for me to get rid of that risk. We're going to talk about something today, again, as Nora alluded to, some acronyms. So something called AMT, the Alternative Minimum Tax, is a parallel tax system to the current tax system. Not going to get into it today because everyone will fall asleep as we talk about it. But it's a way to simply say that if your stock options make up a large portion of your income, then they're going to be taxed at a higher rate. And again, a CPA would be involved, right? Going through those things, coming up with kind of what that alternative tax would be. But ultimately, the government is saying, if you're not getting paid a lot of money and you're getting all your money in stock options, we want to make sure that we're getting our fair share of that amount. And then AMT does not apply to many of the other publicly traded stock options that are out there. For regulation wise, because it's a private company, things aren't done through the SEC. They're not traded on the public market. There's going to be fewer rules kind of how these plans are put together. And we've seen people get to the 4-year time point where their shares are finally about to vest, and the company goes through a restructuring, or they go through a merger, or they're bought out, and those stock options, completely change, or they lengthen the vesting schedule because they're just a smaller firm and it's all privately done. And then the SEC is going to be looking at a public company, making sure they're doing things more correctly. So again, understanding, am I with a publicly traded company like an Apple or a Coca-Cola or anything that I can buy at E-Trade or Schwab is going to be different than a mom and pop shop or a family-run business where I'm getting equity compensation. Oftentimes, we'll see it with startups as well. We've got a big IPO coming out this year with SpaceX. So SpaceX is currently a private company. They do not have to disclose any of their financials with the SEC. I think it's June. They're coming out with their IPO, and now they'll have to start going through the public process and putting all their financial information out there at the SEC. Their stock options are then going to become more liquid when that opportunity arises. So kind of the main ones that we're going to talk about today are going to be restricted stock units. Again, these are the ones that we're seeing most commonly, kind of more recently, really in the last 5 to 10 years or so. These are becoming much more popular, and they're a lot easier to understand when we see them in employee salary, and not as difficult to kind of grasp. Then stock options, incentive stock options, non-qualified stock options, typically reserved for C-suite level executive compensation packages, but that doesn't mean it can't apply to more people. And then lastly, the employee stock purchase plans, really available to everyone in the firm, giving everyone the opportunity to buy their shares at a discount. So we'll go through each of these in depth, make sure you have a solid understanding of what all of them entail and some of the unique tax considerations that are involved.
All right, so let's start with RSUs, or restricted stock units. And when I see these that clients have, I really like to think of RSUs as a company bonus. And so really it's a promise to deliver a company stock at a future date once certain qualifications are met. So as you can see, some of these key terms you'll see throughout the different types of compensation benefits. But, the first is the grant date. And really, think of the grant date as the promise, right? Think of it as your employee offer letter. They're promising you, and granting you these RSUs. That does not mean you own any stock at this point, and you do not owe any taxes at this point. It is just a promise. So that is the grant date, the first kind of step in the RSU process. The next step is kind of where I like to think RSUs get real, right? This is the vesting date. So, once these certain conditions are met, and we see these as like a timeline-based vesting, annually, quarterly, we see performance-based vesting or a mix of both. So once those, vesting requirements are met, you own that stock. And when you own that stock, you pay ordinary income on that fair market value of the stock during that vesting date. And so that's where I kind of see just some misunderstanding when people have RSUs, is that you owe ordinary income. You'll see that on your W-2 when you vest in RSUs. Okay. So kind of the third step, and we just put this in here. This is when the companies deliver the shares to you. And typically we see this, see them visible in, a brokerage account. And you'll see those as, you work for XYZ company. Now you have XYZ shares in your brokerage account. And one key thing I like to say is that when these shares vest and they are now, you can see them, they're visible in your brokerage account. This is what we call the cost basis. This is what you paid. You already paid ordinary income, the fair market value, that's your cost basis. Okay. Now this next step, really, it's just more informative, tax withholding. So some companies will withhold shares to cover some of that ordinary income, but just know there may be, a delta between, the shares that were withheld for tax purposes versus what you'll owe when you file your taxes. So from a planning standpoint, you want to make sure that you're aware of that additional obligation. And again, you'll see that on your W-2. Okay. Step 5 is also another really important step, and we see these a lot with the different types, right? It's that post-vest decision. Do I hold or do I sell, right? So, if I have my CFP hat on, the recommendation from a CFP would be to sell, to diversify, right? It's something that we call concentration risk. So that's when you say, I work for an employer, my salary is tied to this company, my benefits, my 401k is tied to this employee. Now you have RSUs tied to this employer. So, when we say sell, it's to diversify, to reduce some of that risk. Now, we've all, seen and heard the stories of, people that worked at Kodak or Enron. They held a ton of equity or assets within those companies, thinking that they would always do well. And unfortunately, they were on, the downside of that. So that is one of the benefits of selling and diversifying immediately, because you've already paid that ordinary income tax. Okay. So that's one option that you have, is just to sell. The other option is to hold. And in the next slide, I'll kind of go through an example. So when you hold, that also comes with different tax consequence when you're ready to sell. So just know, when you vest, you have two decisions. CFP answer, sell, diversify, or you can hold. And when we work with people, it may make sense to hold, right? If you're someone that has a financial plan, has a strategy for each goal that you have, you're in plan to make all of those goals, you have liquidity and assets outside that aren't tied to your company. You may, I would be fine saying, 5 to 10% to hold on to these RSUs. You may think the company will do well, but just know that if you hold on, you are taking risk. You could say this company is going to do well forever, but we don't necessarily know that answer. So you are taking risk, and you could depreciate that asset. So just a couple things to think about if you decide to hold. Not necessarily a bad thing, but think about where you are in your financial picture. Is it going to be a detriment to your financial picture to put it, heavily into this RSU? So those are things that we kind of work with clients on, and questions that we ask. Okay. Now we'll go into kind of a specific example. And as you can see here, this is showing employee receives 1,000 RSUs. This is like the grant, right? You don't own the stock yet. And the vesting is geared towards timeline. So it's a 4-year vest with a quarter of the RSUs per year. So in this example, year 1, a quarter of that vest. So you get 250 shares. When they vest, that comes with the fair market value of $100 per share. So you pay ordinary income tax on that vesting date of $25,000. So that's whatever your tax bracket is, up to 37%, you will be paying taxes on that RSU when it vests. Okay. So again, here's the decision point. You can either sell, like the CFP kind of recommendation is to diversify, or you can hold. And as I mentioned kind of previously, if you hold, there comes some different tax consequences to consider when you're ready to sell. So let's say, for example, in this first option, this first scenario A, the stock price increased, right? So you hold the stock and now you're ready to sell. You had bought it originally at $100 and now it's $130 per share. Great, right? So when you look at what your cost basis was, right, what you've already paid taxes on when it vests, that was $25,000. That capital gain, that delta, is $7,500. Now, in this example, it's saying you've held that stock for over a year. So that gain, that capital gain, is taxed favorably at the long-term capital gain rate, right? Because you held it over a year. So that's based on your income, probably 15, 20% favorable. Now, let's say in this scenario that you didn't hold it for longer than a year, then you will be paying short-term capital gains at your ordinary income tax rate, okay? So just consider, if you do hold, make sure it's for that long-term tax benefit over a year, okay? Now, in this next scenario, again, okay, maybe you held this stock, you thought this company was going to do, go to the moon, and unfortunately it didn't, right? So now the stock price decreases and you're like, I got to get rid of this, right? So you sell the share at $80 a share. So now your cost basis at vest was still $25,000. The share price is down, so that's $20,000. So you have a capital loss of $5,000. Now, what happens with that? Now, the tax treatment for the $5,000 capital loss, you can offset that gain up to $3,000 off your ordinary income per year, right? So you have a max of $3,000 you can offset from a loss per year with unlimited carryover. So of that $5,000, you'll realize $3,000 for, let's say, 2026 tax year, and you'll carry over $2,000 for 2027. Okay. So a couple different tax scenarios. Again, like Shaun mentioned, RSUs are pretty straightforward. You pay an ordinary income when they vest. You now own them. Now you have the decision to sell or buy, or excuse me, sell or hold. And then that comes with different tax consequences. So pretty straightforward. And I'll toss it to Shaun, and he'll tackle some of the more complicated options.
Thanks, Nora. So now we'll get into non-qualified stock options and incentive stock options. Again, we don't see these as often anymore, but kind of the first thing is you'll see a lot of the same terminology from grant price, grant date, vesting date, so on and so forth. And I think Nora did a great job covering it. So we're going to kind of go over this. So step one is I receive the opportunity, I receive the grant, I get that promise that I can have the opportunity to buy stock in the future. And then that has the same kind of vesting schedule that will be laid out. And once that vesting schedule is complete, and that is the kind of the point where the company is trying to get you to stay with the firm as long as possible. Maybe you've got another job opportunity somewhere else, and you say, well, you know what, if I just stay for 6 more months, then I'll be able to use my stock options, right? That's what they're trying to do. And so I get to that point, and I now have my exercise. And non-qualified stock options, we'll go over a little graph here in a little bit, but ultimately I'm getting the option to purchase shares at a lower value. Okay, so I'm getting an option to purchase shares at a certain price based on what it was on my grant date. If that price is lower than if my grant price is lower than the current market price on my exercise date after my vest, then my option is worth something. If it's lower than that, it's not worth anything. So in this example, my strike price was $20, meaning on this date, I had the opportunity to buy company XYZ for $20 a share, but it had jumped up to $75 a share by the time I'd gone through my vesting schedule and I got to my exercise date. So I've got a spread of $55 that I made by buying stock that's worth $75 for the price of $20. What they'll do is I then own those shares, and now I have to pay taxes on that delta. So in this example, this spread of $55, I pay ordinary income on that $55 because I got the opportunity to buy a share that's worth $75 for $20. And then from there, I have the opportunity to sell those shares or continue to hold them. If I sold them later at $100, minus my exercise price of $75, I'd have a capital gain of $25. So again, I can hold them for longer than a year and make that gain capital gains tax rates, the favorable 15 to 20%. Or if I sell them within a year, similar to RSUs, then I'll come up with ordinary income for a short-term capital gain. So we'll draw this one out a little bit more. On this grant date, I was granted 1,000 options. That was $10 a share. I went through my vesting schedule. I got to my exercise date. The shares are now worth $15. We call that in the money. Okay. I have the opportunity to buy these shares that are worth $15 for $10. I'm going to take advantage of that. That $5,000 delta is going to be taxed as ordinary income to me. Okay. And then from there, I have the same kind of opportunity. Let's say I sold them right away. I got them diversified. That would be the CFP answer. We don't want to have too much ownership in our company stock. So I'm going to decide immediately I'm going to sell them. I don't recognize any more capital gain or capital loss. From there, let's say I decide to hold it. The shares grow to $25. If it's been longer than a year, then I'm paying long-term capital gain. This slide's a little bit misleading because really I bought them at 15. It's gone up to 25. My capital gain would be on the 25 to 15. So I have a $10,000 capital gain. If I sold them within a year, that would be ordinary income. Okay, so non-qualified stock options, not as complicated as incentive stock options, some similarities to RSUs, but if the price has gone down, then this is worthless. And what these NQSOs will often have, right, is an expiration date. We typically see that at 10 years. So if I get this on January 1st, 2020, I have to use it by January 1st, 2030. If I was given them at $10 and the share price has gone down, I may never use it. So I never have any type of capital gain. I never have any type of capital loss. It never cost me any money. I just let the option expire because it became worthless. If as time has gone on, it's gone up, then I'm going to want to take advantage of the opportunity to buy a more expensive share at a lower price. When I do that, I'll recognize capital gain. I'll recognize ordinary income. And then I have the same decision. I now own those shares. Do I buy? Do I hold? Look at my financial plan, and then make a decision. And again, just like Nora, kind of stated, that our typical recommendation is if I'm on track to achieve all my goals and I want to hold 5 to 10% of my net worth or my investable assets in company stock because I really believe in it in the future, then maybe I'll do that. If I have so much of my net worth, so much of my investable assets in my company, I'm going to want to diversify away that risk so that if that company goes under, I don't lose my job, I don't lose my 401k, and I don't lose all my stock options. So really making this a complete part of your financial plan is going to be the most important decision there. Okay. And so again, when to exercise and when to sell, into the money, out of the money, price goes up, I want to take advantage. If it goes down, I don't want to do so. Okay. So either way, I got to make sure I get that done by the end of the expiration date, right? That's when I no longer have any value to my NQSO or my MSO, as you'll see them referred to. Right now, let's go to incentive stock options. These are a little bit different, but a lot of the same terminology. Again, I get a grant date. I go through my vesting schedule. I have an exercise opportunity. In this example, I had the strike price of $20. The shares grew to $80. I have that $60 spread. I will have a $60,000 ordinary income. And this one's a maybe. Okay. So I may have to pay on that. We'll get into this disqualifying disposition that come with incentive stock options. Okay. But ultimately, this is where that AMT tax may come in. Again, if this makes up a large portion, you calculate your normal taxes, then you calculate the alternative minimum tax. Whichever one's higher, the government says, pay me that one. All right. But this is kind of the same opportunity as NQSOs. And then I have to get into this holding period. And again, this is probably a little bit above this presentation, but I want you to know that there's kind of a time period, which I'll go into in a little bit, that decides, do I pay ordinary income or long-term capital gains on the shares that I now own? Okay, so to do that, I have to own the shares for 2 years from the grant date or 1 year from the exercise date. I'll explain that a little bit more in detail. But that, again, is that holding period opportunity. So when I finally sell them, I now have to calculate whether or not this was such a good deal or it didn't work out for me. Okay, so in this incentive stock option plan, similar example, I was given 1,000 shares at a $10 price. I have the opportunity to buy them. I go through my vesting schedule. They do vest. And now I have an opportunity. Do I want to exercise these? Just like NQSOs, if the share price has gone down, they become worthless. There's no reason for me to buy a $5 share for $10. I don't want to pay more for a company stock than it's worth. But if it goes up to $20, then I would love to buy shares of a company that's worth $20 for $10. That's where I may have to pay ordinary income tax on that $10,000 delta. But we get into that disqualifying disposition. Let's say I go and I exercise them. I get the shares for $20. I paid $10 for them, and I hold those shares for longer than a year. I can have this entire $15,000 be long-term capital gain if I've waited 2 years from this period and 1 year from this period. So if I go back to my example, January 1st, 2020, I was given these shares. I exercised them on January 1st, 2021. I now have the opportunity to hold them until January 1st, 2022. And now I can take the full delta between my exercise price and the share price as long-term capital gain. So these ones have kind of multiple steps to decide when I want to sell them, when I want to exercise them, and how I want to pay the taxes. Why these are important? Because if I have these stock options, it gives me the opportunity. It doesn't mean I have to. So let's say this is January 1st, 2020, and now is January 1st, 2021. I have the opportunity to exercise them. But maybe I just had a really good year. maybe my income doubled. I earned a bunch of commissions. Life's been really good for us. I don't want to recognize more in income. And I know that my spouse next year is going to, not no longer going to work because now my job is doing so great. I can say, you know what? I'll just hang on to them until I know I'll be in a lower tax bracket the following year, or at least have my income reduced. So it gives you some flexibility about, do I want to exercise these? Do I want to go ahead and utilize the opportunity, which again comes with risk. We never know what a company stock is going to do, if it's going to go up or down, but ultimately gives you some flexibility with your NQSOs and ISOs, which is much different than RSUs. As Nora mentioned, when that vesting schedule hits and they're given to you, you don't have any opportunity to say, hey, company, I do not want this income. Okay. They're coming to you on those dates and you're going to pay ordinary income tax on it. The key difference between NQSOs and ISOs is I have an opportunity to either utilize it or not utilize it. It's going to depend on what my exercise or strike price is versus the current market value. And do I want to go ahead and take advantage of that opportunity? And again, we typically see NQSOs and ISOs for kind of C-suite level executive kind of positions because they can go ahead and have the opportunity to take advantage if they want to. This is not something we normally see for kind of every employee in the business. All right. And the last one we'll kind of cover is ESPPs.
Yep. Thanks, Shaun. So I've actually seen ESPPs, employee stock purchase plan, become more common. I've seen a lot of clients have this in their benefit package. But when I think of ESPP, think of, the ability to purchase shares at a discount via payroll. So that's where it becomes a little bit unique. So this enrollment period, again, you don't own any shares at this time. This is just you electing to enroll in, let's call your ESPP account. So you will elect how much you want to contribute per pay period into this account for the ability to purchase stock at a later date at a discount. Okay. So this enrollment is just you electing, this is how much per pay period, and it's going to accumulate into this account, which is the next step. Okay. So this is the contribution period. So typically we see this, 3, 6, maybe 12 months where you're really just accumulating all those contributions you're putting into this ESPP account per pay period. Okay. And these are just deductions, again, taking out each pay period. Okay. Now, this is where I'm going to throw another term at you. So 3, the opportunity of the purchase date. Okay. So you can see kind of above there, there's what's called a look back provision. So I'm not going to go into too much detail. I think Shaun's example on the next slide has it, but the look back provision allows you, so you get the discount, right? We said ESPPs are the ability to purchase shares at a discount. Typically we see that around 15%, right? So you already know you got 15. This look back provision allows, if that's written in your ESPP from your company, allows you to pick the lower of a certain time period, right? So let's say a stock is worth, in this example, beginning price of 80. And then when the purchase date comes around, the ending price is 100. The ESPP, the company is going to say, okay, we're going to allow you to pay the $80 per share versus the current market value of 100. So there's a discount. Plus you get the additional 15% discount of the ESPP. So now instead of buying a share at 100, you're buying shares at 68. Okay. So you automatically get, that stock at a discount. You've already accumulated those funds in that ESPP account that you've been putting in per pay period. And so now you go and exercise at the purchase date and you get an immediate discount. So again, at this point, you could say CFP hat, I'm going to sell. You'll pay ordinary income on that delta, right, of that discount that you have. Or you can have what's called, the next slide, the holding period. And similar to an ISO, again, not going to get into too much detail, but you have different qualifying and non-disqualifying dispositions, right? So if you sell within a disqualifying disposition, so if you sell within 1 year of the purchase date and 2 years within the enrollment, then you pay ordinary income on not only the discount, but also the gain, right? But if you sell during a qualifying disposition outside of those time limits, you'll be paying capital gains tax on that. Okay. So again, similar to an RSU, you have a couple decisions here. Sell immediately when you purchase, or hold and diversify, or hold and make sure that you sell with outside of those timeframes so that it's a qualifying disposition. Okay, and then I'll have Shaun kind of go through a specific example, which will probably clarify kind of what benefit an ESPP has.
Thanks, Nora. So we'll look at this. We have a contribution period of 6 months. Again, my employee contribution was $10,000. So think about it this way. I'm not really getting any money for this, right? RSUs, I'm getting shares that have increased how much compensation I have. With an ISO or an NQSO, I'm getting the opportunity to purchase. With these, if my salary is $100,000, I'm electing to say, you know what, company, I believe in you. Just give me $90,000 of income to my bank account and take $10,000 and buy these shares at a lower price. Okay. So this is just an opportunity to buy shares at a lower price. So my beginning stock price when it was offered was $80. By the time the offering ended, meaning after I've kind of got the vesting schedule, is now worth $100. And this is my opportunity to make the payment. I'm going to get that ESP discount of 15%. And typically what we see in these programs is about 5 to 15%. 15% is probably most common, but we see 5 to 15%. All of these things are kind of written out in the plan documents, right? HR sends out the package. Do you want to participate? Here are the rules. That will tell you, is there a look back provision? Not all companies allow the look back provision. And what is the discount percentage that I'm going to get? So all of those things will be covered in the plan documents. So in this example, we're going to use the lower discount, right? I had the look back provision in my plan. So the shares are now worth 100. I get the opportunity to buy them at 80. I'm getting that 15% discount that was in my plan documents. So I'm purchasing the shares for $68. Again, seems like a great deal, right? If I have this opportunity, I'm getting to buy shares at a lower price than they're worth when the buy period happens. Again, if that share has gone down and I have the look back provision, and say this is flipped on the offering date, they were 100 and it dropped to 80, I'd get 15% off the 80. Okay, so either way, I'm getting a good deal if I have that look back provision. So I purchased the share for $68. So the total share purchased was $10,000. By my purchase price, I now get 147 shares of my company that I got essentially a 32% discount on, right? Why wouldn't that be a good idea? And so current market price is $100. I purchased them for $68. My immediate gain is $32 per share. So I'm going to end up paying, getting a $47 value of which I'll have to pay ordinary income tax on. And then I get to my decision point. Do I immediately sell those and diversify that risk away? Or do I hold on to it and get into the 2 years from when it was offered or 1 year from when I actually received the shares? If I meet those, then I get a favorable tax treatment of long-term capital gains, and that can become more valuable. Ultimately, this decision is, one that we get a lot is, should I enroll, right? Should I participate in the ESPPs? And again, it's going to be the same kind of information. If I'm saving enough for my 401k, I have an emergency fund, I don't have bad debt, my kid's college is, being saved for, all my goals are on track, and then you come to me and say, should I participate in my ESPPs? Probably say, yeah, I don't see any reason not to, as long as we're not over contributing, right? No more than 5 to 10% of my pay. I can potentially have a great opportunity to be vested with my company. If I do have some bad debt, I'm not quite on track to achieve my retirement goals, I'm behind in my emergency fund, then typically we're going to say ESPPs are not going to be the opportunity you want. Let's go ahead and make sure I take care of my other financial goals. And once I'm on track there, let me go ahead and get involved in the enrollment period. Okay. So these aren't something that everyone should just run to and do. We want to say, all right, I have the opportunity to participate, which again, unlike RSUs, where they're just given to me, I don't get an opportunity. It's a part of my compensation. ESPPs is an opportunity to be involved in the company. If I'm on track, go for it. Don't do more than that you're comfortable with from a cash flow perspective. You're not hurting your family from a cash flow perspective. You're not hurting your family's long-term goals. The ESPPs can be a great way to participate in your company and buy shares at a discount that No one else can because they're not an employee at that firm. Okay. So, in summary, right, we went over, RSUs, which again are shares that are given to you, and then you have an opportunity to sell or diversify away that risk or hold on to them. But either way, you're going to be taxed ordinary income. Incentive stock options and non-qualified stock option, I have the opportunity to purchase shares at a lower price than they're worth. If that price has actually gone down, then they're not valuable at all. And I'll have some type of expiration period on that, typically 10 years. And then it comes down to, taxes and how will those gains be taxed? What is my decision point there? ESPPs come in with opportunity to participate to buy your company shares at a lower price, but doesn't always make sense for everyone. Got to make sure your financial plan, your goals are on track. And then if you want to go ahead and participate, just don't do anything that would kind of hurt your monthly cash flow, but take advantage of the opportunity to get shares at a lower price. So from there, we'll kind of take a look at any questions that have come in, and then we'll wrap it up for the evening.
Thanks, Shaun. There is one question that's coming in. They are saying that I work for a private company with talks of going public, so an IPO. I am offered employee benefits in terms of RSUs. What happens if my company does not IPO? What happens to those options?
So again, from the private company standpoint, there will be different opportunities that are laid out in the company plan about when you can actually liquidate. Oftentimes, those things will come from a merger with a public company. And so they may exchange those shares for shares of the publicly traded company. We've also seen it where they just go away, right? They purchase them and that opportunity no longer exists. But you oftentimes will have a tender offer. And so the company will say, hey, I want to be good to my employees. Before we kind of go through this merger, I'd like to go ahead and have you either buy those shares from my company. So you'll get cash for exercising those before they go public. So there's lots of different ways that it can kind of evolve. You can either get shares of the new public company, you can get a tender offer for them to buy your current shares, or they could become worthless because they say, you know what, things didn't work out, you never met your liquidity event, and so now you're just an employee of the new firm. All of it will be discussed through the acquisition and through kind of the plan documents and the legal documents that come out through the merger.
Some of the questions that I'm showing, either one, a lot of these options are a little bit too complicated, or one, you guys all know, and we did a thorough job explaining them. But as always, if this comes about on a new employment opportunity, or you just want to learn more about it, please reach out to anybody on our team. We'd happy to talk about your specific situation, when to exercise, what does that mean for you, and what are the tax consequences, and see if that fits in with your financial plan. And just so that, again, you are informed to make a good decision, right? We just don't want you guys making blind decisions out there, especially when you have some a little bit more complicated compensation plans. So as always, reach out to us. Appreciate everybody joining us this evening. And we'll be sending a recording of this along with the registration for our next webinar.
Yeah, and I'll kind of reiterate that with Nora. These are complicated. Oftentimes, I see the decision being made around a water cooler with another employee. Understand that everyone's financial plan is different. So this is certainly one that you want to kind of sit down with your advisor, make sure it's the right decision for you, make sure it's the right decision for your family, and make sure you understand the tax implications. Again, one of the values of working with us, when you jump on with the CPA, make sure everyone's on the same page before you go exercise. The guy or gal at the water cooler may have a completely different financial picture, maybe getting advice from ChatGPT or Google or whatever it may be. Please reach out to us. We'd love to put that plan together with you. And we look forward to seeing you next time.
All right, and then I'm just going to have Shaun show the disclosure page real quick. I think that's not there. There we go. Perfect.
Attorneys are happy now. Attorneys are happy.
All right. Have a good evening, everybody. Talk to you next month.